Well, again, welcome to State of the Markets update. Today we'll do two things, walk through our State of the Market economic update, talk about what's happened in the capital markets this year, where we kind of see ourselves in the long-term positioning there as well. And then second thing that we want to do is go through a presentation on direct lending. If you have any questions with respect to this, don't hesitate to reach out if you're watching on video. And we do have a couple participants here who may pose some questions, and so we'll dive into those at different points as well. So you can see what we have our disclosures there on the front page. Putting the year in context for 2022, it was a rough year in just about every publicly traded market. Whether we look at stocks, whether we look at bonds, we don't have, of course, other asset classes here beyond those two. Looking at real estate, for instance, publicly traded real estate or cryptocurrencies, but those would be another two that took it on the chin last year. As for stocks, putting things in context, the US stock market was down 19.2%. The international developed stocks, and that would be those countries, companies that are domiciled in countries like Japan, Australia, Canada, the European nations, those were down 14.3%. The worst of the performers in stocks, when we think geographically, was the emerging markets, down 20.1%. Again, those would be stocks, companies that are domiciled in China and India and Mexico and Indonesia and other countries that are emerging in terms of the state of their economies. And usually when we see a slowdown in the economy, if we see stocks struggle, historically, we've often seen the bond market do reasonably well. The reason being is that oftentimes as the economy slows down, interest rates drop, and that actually pushes bond prices up. This past year, of course, we had the opposite situation where the increase of interest rates was actually the culprit in many ways of slowing the economy. So that increasing interest rate across the board, we saw US bonds take it on the chin, down 13%. For context, that was the worst US bond market rate of return on an annual basis that we've seen really going back 200 years. If we go back to 1926, since records have been kept in a more diligent way, I guess you could say, we have seen the worst rate of return be down 8.1% in a calendar year. So down 13%, a time and a half that, and then some. Now, the global bond market didn't do quite as poorly, just simply because interest rates in other countries didn't rise quite as sharply as they did in the United States. But again, coming into the year, rates, whether it be on a 30-day Treasury bill or a 2-year Treasury note or a 10-year or 30-year Treasury bond, all very low by historic standards. And in some cases, like the 2-year Treasury note, going from something like 70 basis points up over 4%, we saw an increase that was 5 or 6 times where it started. So a really steep increase. And as we've talked about in the past, as interest rates rise, it's a seesaw effect with bond prices. Interest rates rise, driving down bond prices, and that's why we see the drop there. So a very unusual year from that standpoint. Now, if we turn to really the equity markets and do a little bit deeper dive, the growth companies lagged their value counterparts. If we kind of think about the small value US companies, those companies that are less than $2 billion in their market capitalization and tend to be cheaper on a price to earnings, price to book basis, they performed a little bit better. Again, down only about half of what we saw the US large growth companies. So if you think about US small value, you can think about small banks like Pinnacle Financial Partners or something like that, that would be a local bank that's not particularly small in size in that it's a regional bank, but small compared to maybe the largest of the firms that are out there. If you think about US large growth companies, this would be the Amazons, the Googles of the world, the Netflixes of the world. So they got hit the hardest. In essence, as interest rates rose, the price of their stock fell because the rates of return, the rates of return on invested capital in many ways were expected to marshal a higher percentage in the nearer term. And that's sometimes what interest rate movements do, rather than just looking at long-term growth and having a really low interest rate financing environment. The same story could be told for international value versus international growth stocks. International value stocks, by and large, kept their value much more than their growth counterparts. In the emerging markets, it wasn't quite the same dynamic. You could see the value stocks doing a little bit better than their growth counterparts, but not quite as much in terms of the disparity as what we saw in the US or internationally. If we look at the fixed income side of things and drill down a little bit deeper there, you can see a wide disparity really driven by the duration or the maturity length of the fixed income investment. So on the extreme left-hand side, you could see US government short dated fixed income. This would be US Treasury bills, 30-day Treasury bills, actually posted a positive rate of return. So they weren't paying us anything coming into the year, but as you would invest and then have the note come due, invest and then have the bill come due, I should say, 12 times, over the course of the year, as interest rates rose, you were actually paid interest on those. And that's the story really behind savings and money market accounts now paying us something like 3%, 3.5% at the very top range of what companies might be paying right now. It's that short-term government lending. If we look on the other side of things, the US government long bonds down 29%. So a movement of a little over 1.5% on, say, a 30-year Treasury bond drove the price of that bond, believe it or not, down more than 30%. The coupon payment helped it get back just a little bit under a 30% loss, a 29.2% loss. But again, when we think about that seesaw effect, the farther you are out on the edge of the seesaw, the more the interest rate movement impacts the price. If we look at these other asset classes, the middle one there, US aggregate, so this would be all of the investment grade bonds in the US publicly traded bond market. This would include US Treasury bonds, investment grade corporate bonds, also mortgage-backed securities, down 13%, as I mentioned. If we look at the US high yield bond space, didn't go down quite as much, down 11.2%. And the reason it was down just a little bit less is that the interest rate doesn't impact high yield bonds quite as much because they have a little bit more cushion with the amount of yield that they have there. So that extra yield pickup helped high yield bonds to outperform their US aggregate counterparts. If you look at the emerging market bond side of things, got hit harder than US bonds even, because in those bond situations, sometimes the duration is high as well as the currency movement that would be there. So all told, we have those as different parts of the fixed income landscape. Of course, we could drill in even further, but the fixed income landscape, other than those very, very, very short-term Treasury bills, down uniformly there as well. Now, putting this in context, the best and worst performance, you could see the US stock market there, international, developed, and then emerging market stocks. We had a bad year in stocks, but not close to, say, what the worst quarter would be in any of those arenas. So the US stock market in its worst quarter was down in 2008, the fourth quarter there, when we were in the throes of the global crisis, global financial crisis, there was down almost 23%. By contrast, the best quarter in stocks in recent memory, there, the second quarter of 2020, when we were bouncing back from the COVID lockdown, was up 22%. So even though we had a terrible year in bonds and had a significant drop there, you can still see the worst quarter in bonds performance is nothing like that of what we've seen in stocks. So the first quarter of last year was the worst quarter of performance that we've seen in recent memory for US bonds down almost 6%. That same quarter, global bonds were down about 4%. And then, as we mentioned, over the course of the year, we're down a total of 13% and almost 10% respectively there. Turning to really a blended portfolio. And of course, every client has a portfolio that's tailored to their specific circumstance. But we try to show a blended portfolio of something like 60% in stocks and 40% in bonds to make a bit of a point here. If we think about the worst performance years, going back to say World War II, we could look and say last year was one of the worst performing years for a blended portfolio. Not as quite as bad as 2008. So if you had 60% in stocks, 40% in bonds, 2008 was the poorest of the performers going back to World War II, down about 20%. If you think about 1974, that was the second worst year, down 17%. But last year was the third worst year for that blended portfolio, that 60-40 portfolio. Going back to World War II, we were down about 16% in a 60% stock, 40% bond portfolio, if we're counting the S&P 500 for our stocks, and then the U.S. aggregate bond index for our bonds. So an ugly set of circumstances there. I'll turn things over to Austin as we make a pivot here to talk about where we sit now as a result of these movements and some of the things that we see both in our situation now and then kind of on the horizon.
So as we think about where we are at currently, Spencer mentioned bonds are down, stocks are down. It's been a hard time to be an investor. 2022 was hard, and we can't escape that. But what we want to think about as we are moving forward is there are seasons in the market. And with these seasons, what we're going to see is that 2022, we're dubbing a winter. So if you think about winter, things slow down, life slows down. If we look here at this picture of Cades Cove or of the Smoky Mountains, it just kind of looks bleak and dreary. It's not a place that maybe you want to be. However, the reality of winter is that there can still be beautiful things about it. I know that for our family, we go to bed a whole lot earlier and we sleep more, we read more. There's just a slower, it's a different pace of life. But I think what it prepares us for are times like spring and times of growth. And while in the investment landscape, we don't know when things will rebound, when the flowers are going to come up per se, or the stock market is going to reach new all-time highs. But if we consider the market and the different seasons that the market can have, we would really maybe categorize 2022 as a type of winter. Stocks, their valuations dropped. Bonds, the values dropped. However, bonds started paying us. If we think about things that Spencer has been saying for quite a long time, he said stocks are expensive, bonds aren't paying us anything, and so there's really no place to enter. Well, if 2022 was a winter of sorts, then we've kind of reset the game. Valuations have come down. Bonds are now paying us. There's a more attractive market in a lot of regards. Again, we don't know whether it's January, whether it's December, whether it's March. We can't guess where we're at within this cyclical season. However, we are in a different season. We think that there's something on the horizon. We're going to start off with a Z-score on asset classes. So what a Z-score is we're going to look at 0 as the baseline. And if you think about this, this is the average valuation relative to each of these classes. So we've got bonds, international, developed, emerging market. So what you're thinking here, what you're seeing here is the 0 would be the average value. Anything above 0 means it's expensive. Anything below 0 means it's cheap based on a 20-year average, okay? So all we're looking at is the mean and standard deviation. So how far any of these is relative to their individual mean. So even though the valuations of large cap and small cap are different, the PE ratios can be different, we're normalizing it. So what we want to look here is all of the gray, that's all 2022. So as we look across 2022, US bonds were expensive, municipal bonds were expensive, International developed equities were expensive. Large cap equities were 2.2 standard deviations away from their mean. US growth equities were 2.7. Like, everything is expensive. As we enter 2023, what we're seeing is that things are a whole lot cheaper than they have been. We move from 1.1 standard deviations above the mean to 1.2 below the mean for US core bonds. If we look at US large cap equities, we move from 2.2 above to a half a standard deviation above. There has been a resetting of the valuations pretty much across the investment landscape. There are still asset classes that are above their average. So we look at the US large cap, US value, and US growth. They're still more expensive than their 20-year average, but they're significantly cheaper than they have been last year. So as we move forward, we're going to look at the US Treasury yields. And these are the yields at the end of 2020, at the end of 2021, and then at the end of 2022. So this is our standard yield curve. On the y-axis, we've got what is the yield? So what is a US Treasury paying us if we were to invest? On the x-axis, we've got different maturities. So on the far left, we have a 3-month. On the far right, we have a 30-year. So as you get out further, typically how yield happens is the longer that you are invested, the more you expect to be paid because your money is tied up at a longer place. So a traditional yield curve would look like these two in the gray that's upward and sloping to the right because investors want to be paid over a long period of time. They want to be rewarded for giving their money into the investment for a long time. But what we really want to highlight here is if we look at the 3-month, we're looking at a 0.1% yield at the end of 2020, roughly a 0.1% yield at the end of 2021, and roughly a 4.4% yield for the 3-month at the end of 2022. So over the course of that year, I think the 2021 number was actually 0.06%. So we rounded it up to get a little bit just softer numbers, but that's a significant increase. If you are going from getting paid less than 0.1% to getting paid about 4.4%, that's a very large change. If we move all the way out to the 30-year, we can see that at the end of 2020, it was about 1.7%. So that means your bonds are paying you 1.7% in interest, whereas in the end of 2022, we're seeing nearly a 4% rate. So we have seen interest rates jump up substantially over the course of 2022. And like Spencer was saying, as you see those interest rates rise, that's why bond values, bond prices are dropping. If I have bought at the end of 2022 a 4% bond for 30 years, and Spencer is holding a bond that he has bought in December of 2020, if he wants to buy my 4%, I want to get paid for the 4%. If I'm going to trade my bond with his 1.7%, I want to get paid that extra amount that's going to cover the difference between the interest that he is receiving and the interest that I'm receiving. So as those interest rates rise, that's why our bond prices fall, is because investors want to get paid for those investments that they make. We're looking at some valuations or some projections that Vanguard has put together. And they looked at the US Aggregate Bond Index, the Bloomberg US Aggregate Bond Index, and they said, if you invested $100 as of May 31st, 2021, at the end of December 31st, 2021, here's where your investment would be. It would have gone up and down just a little bit, but by the end of 2021, you're roughly breaking even. Now, their forecast, the green line going forward, is saying what would happen if interest rates did not change? What would happen with the value of that investment in the US Aggregate Index over the course of time? So again, this is not encompassing the value drop that happens. This is just saying at this point in time, if interest rates don't change, we'll follow the green line. Now, we do know interest rates rose in 2022. And so the value of our investment dropped. The value of those bonds dropped. However, because interest rates have risen, Now the Bloomberg US Aggregate Index has a higher yield. The solid gold line there is if interest rates don't move again. So interest rates are staying stable where they were at September 30th, 2022. Again, these are projections by Vanguard. You would, in a couple of years, come back to where your initial investment was. Yes, you lost value. It's going to take, if we were to draw a horizontal line from 100, it's going to take until about 2027 for you to recoup the value lost. But what they're projecting is by about 2029, you will be in a better spot than you were if you had only, if interest rates had not changed. And then going forward, if interest rates, again, if they stay the same, you are going to get the benefit of the higher interest rate. So yes, we experience the pain of interest rates rising, of seeing the value of our bond decrease. However, the long-term benefit due to the higher interest rate is going to start paying off in the next few years. So yes, your value has gone down, but it will return as we continue to get paid by those bonds and at that higher interest rate. So what we're going to look at now is how interest rates have changed since the 1980s. So what we've done here is we've taken the entire yield curve. So again, on our y-axis is the interest rate that bonds are paying. On the x-axis is that time series, the time to maturity. And what we've done is taken every day that these treasuries were available, every data point that the Federal Reserve had, and we've put it on an average. So what was the average yield by decade? And really what we want to show is in the 1980s, we were getting a substantial interest rate from our bonds. If we look at the 20-year, we're looking at over 11% on average for the 80s that you're getting paid on a 20-year bond. I mean, that's a substantial interest rate. But what we see in the 90s, that drops to 6.6. In the 2000s, it drops to 5. In the 2010s, it drops to 2.9. And where we're sitting at as of January 13th was about 3.8%. So we've seen over the last 40 years, our bond interest rates have continued to come down. Pretty much every decade they've decreased. Now, again, this is an average across the entire decade. So there are going to be times within the decade that you're going to be paid more. There's going to be times that you're paid less. But by and large, what we have seen is a decreasing of that interest payment over the last several decades. However, where we sit right now is we're somewhere in between where the 1990s were. We're close to the 1990s average on the 3-month, but we're close to the 2010s average on our 30-year. So the Federal Reserve, we don't know where they're going to go with interest rates. We don't know how many more hikes they're going to take, nor do we know when they're going to start tapering back those rate hikes. However, we think that really there's a big benefit to being an investor in fixed income now that we haven't seen in a long time as rates have risen so substantially. Does it take away the pain? Again, no, it does not take away the pain of seeing values drop. But as we look to the future, we say there is hope. And again, these two yield curves are only looking at US Treasuries. If you're invested in high yield or in corporates, oftentimes those yields are higher than what the Treasuries are. So there are lots of opportunities within the fixed income landscape. Next, as we talked about valuations, we want to look at the valuations of large value versus large growth stocks as a percent of their 20-year average. So what we're looking at here is if you look at the 100% mark, that would be the 20-year average. So if you are above 100%, it means you are more expensive than the 20-year average. If you're below 100%, it means that you're cheaper than the 20-year average. So from about 2013 through 2017, large value stocks were more expensive than their large growth counterparts. And really from about 2014, large value was more expensive than their 20-year average. Not significantly more in 2014, but large value was more expensive. Large growth started becoming more expensive than its 20-year average in 2017. But what we've really seen is post-2020, those valuations really started getting much more expensive. If you remember the last couple state of the markets from 21 and 2020, we've been saying stocks are expensive. If we look at large growth and large value, they're 165.9%. They're significantly above if you're large growth, large value is 129%. So we are above that 20-year average for large growth and large value. However, if you look coming into 2023, well, large values almost back in line with their historic 20-year averages. Large growth is still expensive, but it's not as expensive as it was coming into 2021. Let's look at small growth and small value. So small value is our blue line. Again, till about 2017, small value was more expensive than small growth. And after about a couple years, it started getting less expensive. However, again, we see this major blowout entering 2021, where small growth was 193.5% of its 20-year average. Stocks entering 2021 were very expensive. Now, as we enter 2023, small value is cheap compared to its 20-year average. Small growth is cheap compared to its 20-year average. So again, as we think about seasons, if 2022 was a winter of sorts, it's a resetting, it's a pulling back of these valuations. Yes, our values have gone down, but what is on the horizon? Well, stocks are cheaper and bonds are paying us things. These are things that we haven't been able to say for quite some time. The next thing we want to look at is the quarterly S&P earnings per share. In the blue line, you'll see these are actual earnings until June of 2022. And everything thereafter is an estimate done by Standard & Poor's. So this data comes directly from Standard & Poor's. So everything in blue is what they know as reported data. And then everything in orange is what they're estimating. So as we look, earnings have continued to grow over time. And as earnings grow, it's the analogy that Spencer has used before. He knows when he walks his dog, there is an end line. If he's walking it in an open park, there is an end place. You're going from point to point. The dog might go left, it might go right, it might try to come back to the starting point. But at the end of the day, you know you're moving in a singular direction towards that end. Well, if we think about earnings, earnings are like our dog. They might wander, they might go left and right, but if earnings are pointing us towards the end of the park per se, then that's a leading indicator of where the price of our stock market portfolio is headed. So the earnings in some ways lead the price. We are going to see, if we see earnings estimates continue to grow, then we would anticipate that the price of stocks will continue to grow. Companies are resilient. They want to make money. And part of being a shareholder is getting rewarded for being invested with that company. So companies, the end goal that I always heard in business school, the end goal for any corporation is to make money for their shareholders. So they are going to do what they can to continue to make money for their shareholders. And as we see these earnings, companies are earning lots of money. They're earning maybe not as much as they were at the beginning of 2022 because there has been that pullback. But again, Standard & Poor's does anticipate that by the second quarter of this year,
that we will exceed earnings from the first quarter of last year.
So we do see that S&P is continuing to say there will be a continued growth. Again, do we know when that's going to come? No, we don't know. But what we are seeing is that there is hope on the horizon. One of the last things we want to look at within valuations is the international stock PE discount versus the US. So as we think about this one's a little bit more complex to consider, but what we have here on the y-axis is how much cheaper international stocks are compared to the United States. So these are taking PE ratios of international stocks versus PE ratios of US stocks. If we look at it, the 20-year average discount, over a 20-year average, international stocks are about 14% cheaper than US stocks. Currently, international stocks are about 28% cheaper than US stocks. So if we think about this as where is the average, where is the standard deviation, we are almost 2 standard deviations cheaper than the average discount to the US. So international stocks are almost 2 standard deviations away from their current discount as of December 31st. So international stocks compared to US stocks, they are cheap, and they're cheaper than they've historically been compared to the US. So how does this actually affect us as investors? Well, we think about the long term. We are encouraging clients to be long-term investors. We think that there is more of a probability of return if you are invested for a long period of time. There is a significant amount of volatility if you are a short-term investor. And we don't want to try to guess or project when the next drop or when the next boom is going to be. But what we're looking at here is the range of annual equity returns since 1950. So this is a point to point, and it can be a day-to-day point to point. So we think it could be the 1 year is going to be a rolling. It's January 1st of 2020 to January 1st of 2021, and then January 2nd of 2020 to January 2nd of 2021. So there's thousands of data points in each of these periods. But if we look at the range of annual equity returns since 1950, if we look at the 1 year, your high is as high as 47%. Your low is as low as 39%. So yes, you could have a great 1 year return. You could also have a really bad 1 year return. But as we look out to a 20 year, again, these are rolling periods, your high over a 20 year is 17%, whereas your low is 6%. If we look at bonds and a fixed income range of returns, so your 1 year, your high is as high as 43%. Your low is as low as 13%. Again, the further out we get though, we get that volatility in that short term, but in the long term, a 20-year rolling average annual income, fixed income return, the high is 12, the low is 1. So while we don't see the substantial returns on the 20-year rolling period, we do see that volatility shrinking. And that's why we continue to encourage clients to be invested for the long term. We don't say, try to time the market, because timing the market, as we've looked at before, can really be harmful. So we say, stay invested for the long term, because that volatility continues to compress the longer we're invested. So what does it do for a 50-50 portfolio? So on a 50-50 portfolio, we're looking at a 1 year annual rate of return of as high as 33 and as low as 15%. But what we're seeing is even as you come into a 5 year, those 5 year rolling periods on a 50-50 portfolio, you've now entered the positive space on both the high and the low, 21% high, 1% low. If we come all the way out to the 20 year, you're looking at 14% high, 5% low. So again, do you see the big returns on the 20-year period? Not as big as the one. However, your risk has gone down as you've remained invested for that long period of time. All right, well, I'll go ahead and jump into the economic indicators that we're going to look at. And what we're going to start off with is we're going to look at jobs. And if you are to turn on any of the news programs, any of the business news or just mainstream media news programs, anytime in 2022, you are likely to hear a few words: inflation, recession, doom, gloom, scare. No matter who you are across the media landscape, somebody had something fearful to try to sell you on. And what we're trying to do is kind of pull back some of that media scare tactic, because really what they're wanting you to do is keep watching, because the longer you watch, the more they get paid. And we really want to look at, okay, what does the data say? And again, we are not trying to forecast what recession is happening. We're not trying to forecast where inflation is headed. We're not trying to forecast any of these things of when recovery is going to happen. We're simply saying, let's look at the data and see what the data is showing and what causes for alarm are truly out there or what's not out there. So we're going to start off and look at our unemployment rate. And this is since 1970. and the data was last reported as of December of 2020. So if we look at our 50-year average unemployment rate, it's sitting at 6.2%. The 50-year low, however, is at 3.5%, which happens to be fourth quarter of 2022. Unemployment is at a historic low since at least 1970. So companies are hiring. There are still people that are employed. While yes, I saw recently that certain companies are starting to lay off employees, the reality is the unemployment rate is still low compared to our 50-year average. If we were to look at the ratio of job openings to job seekers, so this would be openings as of 1 month prior to job seekers as of today. So we're looking, this would be November openings to December seekers. What we're seeing here is currently there are about 1.7 jobs for every one job seeker. The 20-year average is 0.7 jobs available to every one job seeker. The 20-year high came in the first quarter of 2022, where there were nearly 2 jobs available for every job seeker. This data comes from the Bureau of Labor Statistics of job openings and BLS's unemployment level. So if we look at this, we're realizing that there are a lot of jobs that are still to be had. Now, are they all ideal jobs for any individual? Maybe not necessarily, but there's a lot of job openings. There's a lot of opportunity that is out there. And I think that's highlighted in some ways by this chart here. And we're going to highlight first the employer quits. So that's that dark blue line. So if we look at where employers are quitting, this is by thousands of employees. A 20-year average had 2.7 million employees quitting on a monthly basis is the 20-year average. Where we're sitting right now is 4.1 million people are leaving the job market every month. So what that's saying is that employees are quitting at a fast rate. And they're quitting at a fast rate because there's jobs available. If we remember back at the last chart, if there's 1.7 jobs for every job seeker, then employees have the freedom to leave their job to go seek employment elsewhere. On a contrasting side, what we look at is employer layoffs. And this data was last reported as of November of 2022. So we don't have the last couple of months. However, I think it still tells a really interesting story in that as the market is pulling back, as interest rates are rising all through 2022, employers are still laying off less people on a month-to-month basis than they have over the last 20 years. Employees are leaving the workforce faster than they have in the last 20 years. I think in a lot of ways, that is a good sign in the labor market. We don't know where that is heading, but I think in terms of economic indicators, that's a pretty interesting fact that people are quitting faster than they're being laid off. Well, what about wage growth? So this is the year over year hourly wage growth for non-farm and non-supervisory employees. So how much did your wages grow year on year? So the 50-year average is 4.1%. Our 50-year high came in the first quarter of 1981 at 9%. We spiked recently in the first quarter of 2022 at 6.7%. And we've tapered back down. By the end of the fourth quarter, wages were only growing at 5%. But wages are growing. Employers are wanting to retain their employees, so they are benefiting them by increasing their wages. Again, if we think about economic indicators that are beneficial, employers want to keep good employees. And one of the ways that you retain your talent is that you pay them and you maintain increasing their year over year hourly wage. And so, yes, part of this is because we have to keep up with inflation, but part of it is just the reality that employers are continuing to pay because employers are continuing to make money. Next, we want to shift over to the inflation conversation. If recession was maybe marked by what's happening in the job market, well, inflation is the other big topic that we're going to talk about. And we've looked at this chart several times. This is the year-over-year change in CPIW. It would be no surprise to any of us that inflation has been high. Everybody knows it. Everybody's seen it in the news. It spiked in the second quarter of 2022 at 9.8%. And where it's sitting at the end of the fourth quarter in 2022 was at about 6.3%. It's above our 50-year average since 1970. Again, not surprising. Everyone's seen it. Everyone feels it. CPIW, this, again, just to refresh your memory, is the Social Security cost of living adjustment. But what we really want to do is we want to drill down a little bit deeper. And we want to see, okay, what happened in 2020 to 2021? So this is November of 2020. How far did these prices increase from then to November of 2021? Well, if you remember at the beginning of November of 2020, we were in the middle of the COVID pandemic. And gas in November of 2020 was really cheap because nobody was going anywhere. Well, it rose pretty substantially by November of 2021. Gas rose about 60%, nearly 60% from November of 2020 to November of 2021. However, the last year, it's still risen, but it's added 10% since November of 21 to 22. So while inflation of gas was really significant in 2021, it's not as significant in 2022. If we look at rental cars, on the other hand, rental cars have dropped 6%. So going from November of 21 to November of 22, rental car prices have decreased by 6%. What about used cars? Used cars were real expensive. They jumped 31% in 2020 and 2021. Well, they dropped 3% in 21 to 22. Where are some maybe areas that are more expensive? Well, rent of shelter has increased in its cost. Shelter cost about 7.2% more at the end of 22 than it did at the end of 21. Food at home, dining out, it has gotten more expensive. Now, what we always want to think about, especially with clients that are that own their home or that have been in their home for a long time and have a mortgage payment that has been around for a while, well, your rent of shelter didn't go up 7.2%. If you have a home that you have paid off in cash, your rent of shelter didn't increase. Your inflation rate here is 0 because it hasn't changed. And so as we look at the next chart, this is the effect of inflation from each of these categories. 32.5% of inflation, nearly a third of the CPIU, the universal or the consumer price index for all urban consumers, nearly a third of it is driven by rent of shelter. So if you are experiencing a 0% rate of inflation because you have a mortgage paid off, or you are not taking out a substantial new loan, or you're not looking for a place to rent, well, your rent of shelter has not increased. So the effect that you are feeling of inflation is not as significant. Now, you're going to be feeling food at home. It's taking up about 8.5% of the inflation that you're feeling. So this is how we want to think about inflation, where as you look at it and you see inflation's at 6%, inflation's at nearly 10%, this is really challenging. It's hard. The media is saying, run to the hills, pull everything out, put it in cash, stuff it under your mattress. Well, again, if you're not renting, well, there's 33% nearly of inflation that is not affecting you. If you're not looking to buy a new car, or you're not looking to travel, or any of these big things, then you may not get hit as hard. Yes, food is more expensive. I recently went to the grocery store and saw that a dozen eggs was $7.50. I don't want to pay $7.50 for a dozen eggs. It's much more expensive than it was a couple years ago. However, I'm also seeing that the price of beef is dropping. So there are ways that we can substitute food at home where we're not getting hit as hard, but we're still feeling that effect of increase of food prices. A couple of the last slides we want to look at, we're looking at the Housing Affordability Index. So this is from the U.S. National Association of Realtors. And if we look at the y-axis, the further up you get on the y-axis is the more affordable a home is. And this is a median priced home for the median income family. Okay, so typically this is, think about how affordable is a median priced home for a median income family. So again, the higher it is, the more affordable it is. So in about 2013, a median family home could afford a significantly more, they had more income to be able to put towards their home in 2013 than they do today. Homes are less affordable for those people today than they were in 2013. So we've decreased the affordability of homes. Now, again, let's take a step back and think about, how does this affect most of our clients? Well, if you have equity in your home, if you have cash that you're available to put down above and beyond a 20% down payment, if your mortgage is not 25% or more of that's their qualifying ratio, 25% of the median price of the home, and the mortgage is above a threshold of about 25% of your income, there's a big calculation they go through there. But if you can buy a home in cash, or if you have equity that your down payment puts a substantial piece of this, you're not as affected by home affordability. The people that are affected by home affordability are likely first-time home buyers with a median or below median income. So people that are buying a second home or selling a home for profit, you're probably okay. And the housing affordability that is saying that we are seeing as maybe played up as a crisis, maybe doesn't actually affect you as significantly as the media wants you to believe. So we're going to finish off. What are the markets thinking about for inflation over the next year? So the University of Michigan takes some consumer inflation expectations, and the 20-year average is consumers expect inflation to be at about 3%. Currently, over the next year, they're expecting inflation to be at 4.9. But what we really want to see is at the beginning of 2022, over that year, consumers were expecting it to be at about 5%, 5.5%. Yeah, it's tapered down. It's maybe peaked back up to 5, but we are looking at inflation that consumers are expecting to come down over the next year. Similarly, if we look at the 5-year expectations, so the 5-year break-even is the difference between a 5-year Treasury inflation protected security, so a 5-year TIPS versus a 5-year Treasury note. So the difference there is 2.3%. So the market is pricing in inflation over the next 5 years at about 2.3%. Consumers are coming back down to about a 3% expectation. So in a 5-year span of time, we are expecting inflation to come back to where we would say are pretty historical norms. Finally, we want to finish where we started and looking at these Z-scores and the asset class valuations. Again, just as a reminder, 2022 was rough. It saw our values drop. It made, if we were watching a lot of news, it may have made us fearful of recession and inflation. But hopefully we're able to quell some of those fears and be reminded that, okay, as we enter 2023, there's some hope on the horizon. Do we know if spring has sprung? No, we don't. Do we know, can we guarantee that there's not going to be more drops in our portfolios? No, we can't guarantee that. No one will know when a market bottom is going to come. But if we look at economic forecasts, if we look at the valuations of everything, we're really seeing that things have started to turn around. There has been a reset. And as we look forward, I think there's some hope on the horizon in the midst of what has been a harder year in 2022.
The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents.